Sharp drops or rises in commodity prices and central banks going their separate ways on monetary policies are just two factors that could make a fine investment decision go pear-shaped mighty quickly. The largest investor in the world is BlackRock, and this week one of its global rates investment team is out talking to clients. Joe Di Censo previously worked at the IMF and was a lead author of the IMF's Global Financial Stability Report. I spoke with him earlier. Joe Di Censo, it's good to talk to you.
Thank you.
Let me ask you about oil first, because we've had this dramatic fall in oil prices. What impact do you see on investments?
Well, twofold. As with anything, there are some winners and some losers when it comes to oil prices. And the economies that are going to be most difficultly affected are those that are oil producers, of course. But in the emerging economy universe, there are some that actually benefit from this. And we see certain emerging markets like India, South Africa, and Turkey that are standing to benefit because of the improvements in their external accounts from falling oil. So even though there are some economies that are going to struggle, and we know where those are, Russia in particular, we see on net that this is not clear-cut for emerging markets as either positive or negative.
So this could be quite a change, because a lot of investors have been shorting emerging markets, until very recently, presumably. Is there a new flow of money into emerging markets now?
I think into those economies that, as I said, will stand to benefit, and India is a particular one because of its improving terms of trade now with oil prices falling, with lower inflation that's going to enable the central bank to have more flexibility, possibly to cut rates. That's quite important.
I saw an opinion piece in the FT overnight suggesting that somehow this was all going to lead to potentially an equity bubble in New York, partly because you'd get consumers benefiting, inflation coming down, so not such a big push on interest rates going up again, a strong US dollar and investment into the US.
I think that's a very debatable point, and I would probably counter that argument by saying that the fiscal stimulus that comes from having falling energy prices, and gasoline is now below $3 a gallon in most parts of the United States, is a very powerful stimulus for the economy. The Federal Reserve is also suggesting, including Mr. Dudley speaking overnight, president of the New York Federal Reserve Bank, that this probably is more growth enhancing for the U.S. economy than it is disinflationary. And it's worth remembering that the disinflationary impact from falling commodity prices is probably transient.
So you're saying that there will be pressure on the Fed to actually move on rates earlier rather than later?
That's our opinion. And then we think the Federal Reserve begins raising interest rates much earlier next year than what is currently priced in, as early as possibly the early second quarter of 2015.
Now the debt market's ready for this?
Well, the debt markets are not priced for that insofar as they estimate and they price in the first rate hike in the third quarter of next year. And I think that subsequently the debt market is also too benignly priced for the normalization of interest rates in the U.S. But it's worth remembering that these tend to be very short-lived dislocations, and the front end of the U.S. yield curve, the shortest maturities, will reprice quite quickly, in our opinion.
So there won't be a huge market shock, in your opinion?
Not a market shock. The Federal Reserve has done a good job of telegraphing this, but it's never a smooth process of adjustment either.
Now, Joe, what about currencies, and particularly with these sort of different strategies by central banks in terms of quantitative easing around the world?
We think it's a fantastic time to actually be actively investing in currencies. When you have divergent monetary policy, basically when you have more interest rate dispersion, it tends to produce very strong currency trends. This was the case in the US dollar in the 1980s, and we think we're seeing a similar trend where the US dollar is appreciating not just because of the positive interest rate differentials or growth differentials, but also coming back to your earlier question about energy, the newfound domestic sources of energy discovery in the US. So we're firmly of the view that the dollar continues to appreciate, not in a linear fashion, but over the course of 2015, and that this is the beginning of a stronger dollar period that has sufficient legs to last for quite some time to come.
And does this mean that our Aussie dollar is going to push lower?
Well, the Aussie dollar has moved quite a bit. It
Yes.
has depreciated significantly. I think that the backdrop of slower growth in Australia, of interest rates that are not moving higher, if anything, potentially poised to move lower.
Yes, we heard about that today. The banks are, a couple of the investment banks are changing their views today that the next movement, if anything, the RBA is going to move down.
Indeed. And the rates market in Australia is beginning to price in interest rate cuts. So we think that the next move, if there is a move, is a downward move. And that dispersion of short interest rates between Australia moving lower and the U.S. moving higher is a catalyst for the Aussie dollar to continue weakening.
So what does this mean for how BlackRock, for example, would view Australia as an investment destination?
We're actually very favorably disposed to Australian government bonds for those reasons, that there is a weaker growth backdrop, that the RBA is more inclined to be on hold or, if anything, potentially cut rates. And if they do cut rates, it would be more than the 25 basis points or so that is mainly priced in. So we're favorable on Australian government bonds, and we're negative on the Australian dollar by being underweight that currency.
Now, Joe, you're based in London. What do you make of Europe's attempts to wrestle with deflation?
And that's exactly what they are doing. They're wrestling, unfortunately, not in a very convincing way. And we think that policymakers are going to be quite reluctant to undertake very aggressive policy measures for the reason that, one, the European Central Bank is not sure that this is a genuine deflationary environment. Secondly, that they don't really believe in the monetary policy tools at their disposal. Effectively, Europe needs fiscal policy stimulus, and politically that's just very contentious right now.
Are you worried about it? Again, from an investment point of view, what's BlackRock's position on sovereign bonds around Europe?
The sovereign bond market in Europe is fully priced for quantitative easing. And so there's not really much additional yield compression or spread compression that could materialize if and when the ECB decides to undertake full-fledged government bond QE. What is more attractive for us is actually European bank shares and European bank debt, as well as being short the euro. The currency is generally, in these quantitative easing experiments, the most reactive asset, and that's one where we see additional downward pressure.
Presumably you have to pick your bank, though, in Europe?
Very much so. It's a question of good stock selection. But generally speaking, the ECB's measures are very beneficial for European banks, both through lower funding costs and purchases of assets.
And Joe, we've had a lot of talk with the Financial Stability Board about banks that are too big to fail. What about asset managers that are too big to fail? Because BlackRock is now, I think, the biggest investor in the world, $4.5 trillion US. And we've now got US regulators raising concerns, perhaps, about systemic risk.
Well, size is a very difficult thing to measure in the asset management industry. Looking at assets under management is a very crude metric because the assets that are managed belong to the clients, and we are fiduciaries for those clients. They're not our assets. It's not our balance sheet. So you actually make money in terms of your fees, rather than running a book? We make money when our clients make money. Yeah. And as a result, when we discuss these issues with regulators, systemic risk and how potentially asset managers could be viewed as systemically important financial institutions, what we try to convey is that it is not the size but the interconnectedness of a financial institution that is the important variable to monitor and to observe.
Do you think, though, there's an argument that even though you have very different products, that when it comes to talking risk, there is a group think at any organisation, and could that create some form of systemic risk?
It's a very important question, and I don't think that that is as pervasive as one would think. So an organization like BlackRock is a very diverse organization of hundreds of investors who operate in separate discretionary strategies across a multitude of asset classes. So groupthink is certainly a market concern. It's something that we have to all be attentive to as investors, but it pervades any single investment firm or any single investment manager.
Next year, how do you see markets going?
Well, it's too easy to say that this is going to be smooth sailing. We've always found that transitions of monetary policy are disruptive. that the Federal Reserve beginning to raise interest rates has knock-on pernicious effects to risky assets, so equities, emerging markets have to be very attentive. And let's not forget that coming back to Europe, we have a large economic bloc that's going through a very difficult growth period. So it's going to be challenging. There will be periods of volatility, and it's a time when we think that active investment management has the opportunity to take advantage of these diverging policies.
Joe Di Censo, very good to get your perspective. Thank you.
Thank you.